Hello friends, welcome to Ria's classes. So in the previous session, we started with our introduction to accounting chapter. So in this we discussed the meaning as well as need for accounting. We also discussed the process of accounting as well as the history and development of accounting. Okay, so we also discussed about the inventor of our double entry bookkeeping system. So today we are going to continue with the chapter. First of all, we are going to understand the debit as well as credit terms. Hello. So we know that Luca Pacioli, he did not claim that he was the inventor of double entry bookkeeping system, but he just spread the knowledge of it. Okay, so he used this two main terms, debit as well as credit. Okay, so debit basically comes from the Italian debito, which comes from the Latin debita, and debio, which means owed to the proprietor. And credit, it comes from the Latin word credo, which means trust or belief. So this is very important conceptually. For example, if a customer buys goods on credit, okay, then the business trusts the customer and the customer owes money. So that is credit. So Pacioli basically he gave this golden statement. He wrote all the entries have to be double entries. If you make one creditor, then you must make some debtor, meaning that every transaction has two sides. For example, if a business buys furniture worth rupees 20,000, then the furniture increases, which is debit, as well as cash decreases, which is credit. So, two effects always are there. So, basically, we can say that every transaction has dual effect. Hello. So he also stated that it's a merchant's responsibility. Merchant's responsibility is to give glory to God in their enterprises, to be ethical in all business activities, and to earn a profit. He discussed the details of memorandum, journal, ledger, and specialized accounting procedures. So the text says that Pacioli basically believed uh, to be ethical. So accounting, it is not just technical; it's also a moral responsibility. So if accounts are manipulated, then the investors they will lose money. Also the banks will suffer and the society also suffers. So basically accounting it builds trust. Hello. Okay, so next we have economic event. So business organizations they involve economic events. It is known as a happening of consequence to a Economic event is known as a happening of consequence to a business organization which consists of transactions and which are measurable in monetary terms. So, let us now break down this thing slowly. Okay, so what is economic event? First up, we have is economic. So, economic means something which is related to money. Okay, an event when we say it means something that happens. So economic event is basically something that happens and it affects money of business. Okay. For example, you purchase a machinery. Okay. But purchasing machinery includes buying the machinery. It involves transportation cost as well as installation cost, trial, run expense. So all these together they form one economic unit. So accounting basically it groups related transactions. Hello. So thus accounting identifies bunch of transactions related to an economic event, and if an event involves transactions between an outsider and an organization, these are known as external events. So the text gives examples like we are making sales to customers, we are rendering services, we are purchasing from suppliers, and payment of rent. So these all involves outsider. So transaction basically between business as well as outsider is called as an external event. For example, if ABC Limited sells goods of rupees 50,000 to Ravi, it is an external event. If business pays rent to landlord, it is an external event. Now we have another term, internal event. Okay, so internal event is an economic event that occurs entirely between the internal wings of an enterprise. Example, supply of raw materials or components by the stores departments to the manufacturing department, payment of wages to the employees, etc. Hello. So all this basically does not involve any outsider, but it affects the business. Now think of business as a body. If hand gives object to mouth, internal movement is there. But if you give money to shopkeeper, then external movement is there. Next we have identification, measurement, recording as well as communication. Okay, so what is identification? Identification basically means determining what transactions to record. So first we are identifying what events are to be recorded. So it involves observing activities and selecting those events that are of considered financial character and relates to the organization. Okay. So first of all, we'll ask a question: do we record everything? Okay. The answer would be a big no. So basically, only those events we record which are financial in nature and can be measured in money. For example, appointment of manager, it is important, but it is not recorded in books. Why? Because we cannot measure money, because we cannot measure the value of appointment in rupees. But all these are recorded, like sales, we have purchase, we have salary payment. Why are we recording this? Because all this involves money and is measurable also. So the rule is that if it cannot be measured in money, then it is not recorded. So first of all, we identified, then we measured. Okay. So measurement, when we say, this is basically quantification, quantification in monetary terms. Example, everything must be converted into rupees. Like if we bought 100 chairs, so we cannot measure it. But if we say we bought 100 chairs for rupees 50,000, yes, we can record this because it is measurable. So without money value, accounting will not work. So we discussed identification, we discussed measurement. Next we'll discuss about recording. So recording in this, so once we have identified as well as we have measured, we now record things chronologically in date wise order. For example, if in April we purchased goods worth rupees 20,000, and in April, 1st April, and on 2nd April we sold goods worth rupees 15,000. So basically we are not recording this on random basis, we are recording it date wise in a systematic manner. So in systematic order we are recording. Hello. Next we have communication. So communication is very important. So let us see, why do we record? We are recording because we have to communicate. So who are we going to communicate this to? We are going to communicate it to management, to investors, to banks as well as to government. Through what? through our financial statements as well as through our reports. So basically, the right information to right person at right time. This is to be done. So basically, timing matters. So this is what is written. The economic events after identifying, measured and recorded in order that the pertinent information is generated and communicated in a certain form to management and the other internal and external users. And the information is regularly communicated through accounting reports. These reports provide information that are useful to a variety of users who have an interest in assessing the financial performance. Many users are there. We discussed now management, investors, banks, government. So all of them they use for their own specific purpose. So, in planning and controlling business activities and making necessary decisions from time to time. And the accounting information system should be designed in such a way that right information is communicated to right person at the right time. Okay. Hello. So next we have organization. Organization basically it means business entity. So it can be the sole proprietor, sole proprietor. We can have partnership, we can have cooperative society, company, local authority, municipal corporation, or any other association. So basically, accounting it applies to all. Even NGOs they need accounting. Even government bodies need accounting because wherever money exists, accounting also exists. So we'll discuss about the interested users of information. Okay, so we know that accounting is basically a language of business. So why are we calling it language? We are calling it language because it communicates financial story. So there are now two types of users. First of all, we have internal users. The second one we have external users. So, so internal users are basically those who are inside the organization. For example, CEO, CFO, managers, supervisors, financial officer. They use accounting to basically plan, control, as well as make decisions. Next, we have external users. Okay, so external users are those who are outside the organization. Example, we can have investors, can be banks, can be debenture holders, tax authorities, SEBI, regulatory bodies, labor unions, as well as customers, etc. Owners, shareholders. Now we'll discuss about why do the users want accounting information. So we know that if we discuss about owners, okay, owners or shareholders. So they have invested money and they want to know like are they going to get any return? Is the company financially healthy? Is the company financially healthy? If profit increases, then they'll become happy. And if loss is there, then they will be concerned. Then we have directors, managers. So basically, they compare the current year versus previous year. They compare the company's data with company versus the industry. Why are they doing so? To identify strengths as well as weaknesses. So they also check if invested money is getting adequate return or not. Then if we talk about creditors, banks, So basically, they are going to use accounting information to check our liquidity. Liquidity means our ability to pay debt on time. For example, if the company has cash of rupees 1 lakh and it has loan of rupees 50 lakh, so basically bank is going to hesitate in this case. Hello, we have prospective investors. So basically they decide should I invest or not. So they are going to check the profitability, growth as well as risk. Hello. Next we have government as well as regulatory agencies. So government basically what do? They check the VAT. They need information to check VAT for income tax, for compliance with Companies Act, for SEBI regulations. So accounting basically ensures legal compliance. Now let us see accounting as a source of information. So basically accounting it begins with identification and it ends with financial statements. But generation of information is not end in itself. Information it must basically help in decision making. So what accounting must do? The accounting must basically ensure it provides information for making economic decisions. It helps to predict the cash flow. It helps to evaluate management efficiency, disclose assumptions, as well as it must provide social impact information also. For example, if the company plans expansion, then the accounting must help to estimate future cash flows, cost of expansion, as well as expected profit. So basically, accounting it supports planning. Hello. Now let us move further and understand why branches of accounting emerged. Now, students tell me if one doctor can treat general fever, then why do we need specialists like cardiologists, neurologists, as well as surgeons? Because problems become complex. So, same logic also applies to accounting. Earlier businesses, they were small, they were family run, they had limited transactions, and there was no global trade. So basically, for that, only one type of accounting was enough. But if we consider the modern situation, so today businesses they are multinational, they are technology driven, they are data heavy, they are highly competitive, as well as government regulated. So basically, accounting had to expand. Thus, the growth of business complexity led to specialization in accounting. Now we'll study about our first one thing, financial accounting. Hello, this financial accounting is one of the sub disciplines within the accounting discipline. Okay, we have three. We have financial accounting, we have cost accounting, as well as we have management accounting. So starting with financial accounting it basically deals with keeping a systematic record of financial transactions, preparation and presentation of financial reports in order to arrive at a measure of organizational success and financial soundness. Okay, so first of all, we'll understand this thing recording. Okay, systematic record. So, what are we recording? So, recording means we are writing the transactions in our books, but this recording it is not some kind of random writing. So, this recording must be systematic, it must be chronological, as well as it must be accurate. For example, a grocery store, okay, owner, he would write like this, like for 1st April, he purchased goods for rupees 50,000. 2nd April, he may write if he sells goods, then sale he will write rupees 20,000, and on 3rd April, paid salary rupees 10,000. So basically, all must be recorded. So if the owner forgets salary payment, then profit it will be overstated. So recording basically ensures truth. Then we have classifying. So classifying, after recording, we group similar transactions. For example, all the sales we'll group it together, all the purchases together, all the expenses together. Why? Because grouping gives us clarity. Now suppose we have 200 sales entries. So instead of reading 200 sales entry, we calculate the total sales, that is rupees 5 lakh. So that is called classification. Then we have summarizing. So in summarizing, basically after classification we prepare trading account, we prepare profit and loss account, as well as we prepare balance sheet. So these are basically summaries. So instead of thousands of entries, we are basically getting a structured report. Hello. Now, what is the purpose of financial accounting? Purpose. The main purpose is to provide financial information to the external users. Now, who are these external users? They are investors, they are banks, government, suppliers, credit rating agencies, etc. For example, if a bank is giving rupees 5 crore loan, then will it trust verbal statements? Obviously, no. It will demand audited financial statements, and thus financial accounting builds credibility. Hello. Now we'll understand the nature of financial accounting. So financial accounting is basically historical, it is rule based, it is periodical, as well as it is standardized. So financial accounting basically it answers what happened. It does not answer what should we do. That is management accounting. So financial accounting equal to historical plus standardized plus external users. Next, we'll study about cost accounting, another subdiscipline. So, cost accounting basically assists in analyzing the expenditure for ascertaining the cost of various products manufactured or services rendered by the firms and fixation of prices thereof. It helps in controlling the cost and providing necessary costing information to management for decision making. Okay, so basically, this is helping us to understand what cost accounting is and how cost accounting determines the cost and helps us to control the cost. Okay, now let us see why cost matters. Okay, so first of all, we know profit equal to selling price minus cost. So if the cost rises, then profit falls. So basically, cost control directly it impacts the survival. For example, in a manufacturing company, if the company produces 1,000 tables, cost per table is like for wood it is rupees 2,000, labor cost is rupees 1,500, factory overheads is rupees 500. So basically the total cost is rupees 4,000. So if the selling price is 3,800, okay, so that means you are at a loss because you are selling less than 4,000. The cost of production is 4,000 and you're selling it at 3,800. And if the selling price is 5,000, that means you are at a profit of rupees 1,000. Hello. Now, what is cost control? Suppose your standardized material usage is 10 kg, but when you made the product, you actually used 14 kg of the raw material. Okay, so this was the standard material usage, but actually when you used 4 kgs more. So basically your wastage is of rupees 4 kg. So basically cost accounting, it helps us to identify these inefficiency. Then management investigates, is there any theft, is there any poor quality material, are the workers inefficient or not. Hello. Then we'll study about cost reduction versus cost control. So cost control, basically it means cost control, we are controlling, so basically we are preventing any excess spending. For example, if you're switching to energy efficient machines, so it will reduce the electricity cost permanently. Now let us see the importance of this cost accounting. First of all, it helps in budget preparation. It helps us to evaluate our performance. It helps to in product pricing. Help It will help you to decide the correct price of the product. uh, then you can also do profit planning, how you can make profit, and then inventory control. Okay, so if the company does not know the cost, how can it compete in the market? So it would be impossible. Okay, so cost accounting basically ensures competitiveness. So cost accounting equal to cost measurement plus control plus competitive advantage. Hello. Next, we have management accounting. It deals with the provision of necessary accounting information to people within the organization to enable them in decision making, planning, and controlling business operations. Management accounting draws the relevant information mainly from financial accounting and cost accounting, which helps the management in budgeting, assessing profitability, taking pricing decisions, capital expenditure decisions, and so on. Besides, it generates other information, quantitative, qualitative, financial, and non-financial, which relates to the future and is relevant for decision making in the organization. Such information includes sale forecast, cash flows, purchase requirement, manpower, etc. Okay. So basically, what is management accounting helping? It is helping in planning as well as decision making. So it is basically using your financial data as well as your cost data, but it is future oriented. Now talking about budgeting. Okay, so company basically prepares budget. Or what is budget? For example, your expected sales was rupees 10 crore. Your expected cost is rupees 7 crore. Then your expected profit is rupees 3 crore. So basically this is guiding your operations. Also, decision making, for example, should the company continue with the product A, should it close branch B, should it invest in automation? So management accountant basically analyzes the break even point, return on investment, as well as other risk factors. So this basically has a flexible format. There are no strict legal rules for management accounting. It is for internal use only, and it is confidential. Hello. Now let us see a comparison table. This financial accounting, it is for the past. Cost accounting, it is on cost focus, and management accounting, it is for future decisions. So basically management accounting equal to strategy plus forecast plus planning. Hello. Next, we'll move towards the qualitative characteristics of accounting information. So, first of all, we have reliability. Okay, so let's see what are the qualitative characteristics. They are basically the attributes of accounting information which tend to enhance its understandability as well as usefulness. So, in order to assess whether is decision useful, it must possess the characteristics of reliability, relevance, understandability, as well as comparability. So, we'll discuss each one in detail. Now, what is reliability? When we say reliable, a thing is reliable, information is reliable. What does it mean? Reliability means it is accurate, it is complete, it is neutral, as well as it is verifiable. For example, if the company hides liabilities, then information will become unreliable. Investors would suffer, and so thus the accounting must be honest. Then we have relevance. Relevant information basically it influences decisions. So if the management is deciding on pricing, then the cost data is relevant. Office decoration cost is irrelevant. So we have two components. First of all, we have the predictable value is less the feedback value. And next we have understandability. So understandability means the information must be clear. So basically, whenever you are making financial statements, the financial statements it must be structured, it must be properly labeled, it must be transparent, but also users must have basic knowledge also. Okay, so here understandability basically it means decision makers must interpret accounting information in the same sense as it is prepared as well as conveyed to them. In the same way, they must be able to understand it. The qualities that distinguish between good and bad communication in a message are the fundamental to understandability of the message. A message is said to be effectively communicated when it is interpreted by the receiver of the message in the same sense. Okay, so the receiver is understanding it in the same sense in which the sender has sent. Okay, a counter should present the comparable information the most so relevance as well as reliability must not be sacrificed. Next, we have comparability. Hello. So, comparability it means that the user should be able to compare the same company across different years as well as different companies in the same industry. Now, why is this comparison important? Okay, so if I tell you a company made rupees 5 crore profit, so is that good or bad? What do you think? Okay. So we cannot answer it without any comparison. You will ask, what was the last year's profit? What was the last year's profit? What is the competitor's profit? What is industry's average? So profit basically alone, it has no meaning without any comparison. Now, for example, we can do time comparison also. Time comparison. For example, company ABC. It has 2023 profit of rupees 3 crore, and in 2024 the profit it rose to rupees 5 crore. So now we can say that the profit it increased by rupees 2 crore. So basically the performance has improved. Then we have intercompany comparison. For example, company A's profit margin is 8%, companies B's profit margin is 18%. So investors may choose company B over A. So basically comparative comparability it helps in investment decisions. Now let us see some of the conditions for comparability. Okay, so conditions are the accounting period must be same The accounting policies must be same, as well as same measurement units must be there. Okay, now we will see example of lack of comparability. For example, company X values its stock using FIFO method. We will understand this all these methods in advanced classes. Okay, so company Y uses a different method for stock valuation. So profit figures, they may differ even if sales are same. So basic for that, uniformity is very important. Okay. So basically, comparability equal to consistency in policies plus uniform reporting. So if the accounting policies change every year, then comparison will become meaningless. Therefore, consistency principle is the foundation of comparability. Now let us see why objectives of accounting are necessary. So why does accounting exist? Not just to write entries, but accounting has clear objectives. Without objective, activity has no direction. Let us see the main objective. The main objective of accounting is to provide useful information for decision making. Now we'll move to the objective by objective. Okay, first of all, we have maintenance of records. Okay, so accounting maintains systematic records of business transactions. Now, why is record keeping so essential? Now, we know business, it involves hundreds of purchases, thousands of sales, multiple expenses, loans, as well as repayments. So, human memory, it cannot store everything accurately. For example, in a supermarket, many daily transactions are there, like sales can be of 2 lakh rupees, purchases can be of 1.5 lakh, expenses can be of 30,000. So, after 30 days, can the owner remember all these details? No, it's impossible. So hence accounting, it helps in recording all these transactions. Then we have legal importance also. Accounting basically records uh, accounting records that serve as evidence. So in case of any tax dispute, fraud investigation, legal claims, proper records basically protect the business. Hello, we can use it also for control purpose. For example, recording helps us to detect fraud, it helps us to detect errors, if there's any missing inventory, if there's any excess expenses. So, without the records, control is impossible. So, basically, maintenance of records equal to accuracy plus control plus legal evidence. Now, we look at the calculation of profit or loss. Okay, so second objective is to ascertain profit or loss. Let us understand this deeply. Now, what is profit? Profit is equal to your revenue, whatever sales you are making, minus your expenses. But conceptually, profit is increase in the owner's wealth. For example, you have revenue of rupees 10 lakh, you have expenses of rupees 8 lakh. So, your profit would be rupees 2 lakh. So, basically, your owner's wealth is increased by rupees 2 lakh. Now, why does this profit matter? Profit matters because it indicates our efficiency, it helps to attract investors, it helps in expansion, as well as it helps us to determine the dividend. For example, investor decision is if the company earns profit continuously for 5 years, then investor will feel confident. And if the company makes continuous loss, then risk will also increase. Now we'll understand what is loss. So loss is basically when your expenses exceed exceed your revenue. So loss basically indicates inefficiency, it indicates poor pricing, high cost, as well as declining demand. So profit does not mean cash. Company may show profit, but cash may be tied up in receivables. Okay, so this opens up our discussion on accrual concept. Now, so we studied that profit is basically a performance indicator. Next we have is depiction of financial position. So the third objective is to show the financial position. So this is done through balance sheet. Okay, so basically what is financial position? It helps us to answer what business owns, that is your assets, what the business owes, that is your liabilities, and what is your owner's equity. Hello. For example, your assets may be like you have cash of rupees 3 lakh, you have machinery of rupees 7 lakh, you have liabilities, loan of rupees 4 lakh, you have owner's equity of rupees 6 lakh. So this basically shows strength. Now, why is financial position important? Because we know banks check before giving loans, investors check before investing, as well as suppliers check before giving credit. So basically, profit shows how well business has performed, and balance sheet shows how strong business stands. Okay. So balance sheet is equal to your financial strength snapshot. Next, we have providing accounting information to users. Okay, so providing information to internal and external users is very important. So accounting is basically a communication system. Okay, we have internal users like managers, directors, department heads. So they need information for planning, controlling, decision making, for budgeting. And our external users, we have investors, we have banks, we have government, we have suppliers, we have customers. So they all use information to decide the investment, to grant loans, as well as to assess our stability. So all the basically previous objectives lead to this. Records are our basis. Profit calculation, this is performance, and our financial position. Financial position equal to stability. So altogether basically provides information. So we can write our final integration, records, profit, position, and last we'll take the decision. Hello. So till now we studied that accounting is not merely about writing numbers, it's about preserving records, measuring performance, revealing financial strengths, as well as communicating meaningful information that drives responsible economic decisions. So, after understanding the objectives of accounting, why accounting exists, we'll move one step ahead. Now, just tell me, what role do you think does accounting actually play in a business? So, objectives, we know objectives, it tells us the purpose, but role basically it tells us the impact. So, first of all, for centuries, the role of accounting has been changing with the changes in economic development and increasing societal demands. It describes and analyzes a mass of data of an enterprise through measurement, classification, summarization, and reduces those data into reports, statements, which shows the financial condition, results of operations of the enterprise. So it is basically considered as a language of business. So accounting is a language of business. So just like English is a language used for communication, accounting is a language which is used for business. So when a company says that it has a net profit of rupees 5 crore, it has an asset of rupees 20 crore, it has liabilities of rupees 8 crore. So basically, through this information, investors immediately understand its financial position. So without this accounting language, business communication, it would collapse. So remember this line: accounting is the language of business. Also, it also performs the service activity by providing quantitative financial information which helps the users in various ways. So, accounting as an information system collects and communicates economic information about an enterprise to a wide variety of interested parties. However, accounting information relates to the past transaction and is quantitative and financial in nature. So when we say accounting, it's a historical record. So basically, accounting, it records past financial events. So it basically tells us what happened last year, how much did we earn, how much did we spend. So this historical data basically it helps the management to analyze the performance and to identify the trends. But remember, accounting mainly deals with past data and not predictions. So next we have, however, accounting relates to past transactions and is quantitative financial in nature. It does not provide qualitative and non-financial information. So these limitations of accounting must be kept in view while making use of accounting information. Now let us see accounting as a current economic reality. So the balance sheet it shows the current financial condition of a business. I now think of it like a medical report. So just like health report shows whether a person is healthy or weak, so balance sheet it shows whether a business is financially strong or is it financially weak. Next we have accounting as an information system. So accounting basically what it does, it collects financial data, it processes it, it converts it into reports as well as communicate it to the users. So without accounting, management decisions would be based on just guesswork. With accounting, decisions are data driven. Accounting as a service activity. Accounting serves users, it provides information to investors, to banks, to management, to government employees. So it basically it builds trust, and without trust, no business can survive. Hello, let us see what are the limitations of accounting. So, accounting we know it is powerful, but it is not perfect. First of all, limitation one is only financial information. Okay, so the accounting it does not record employees' morale, it does not record the brand value, it does not record customer satisfaction, but these factors still affect the business. Limitation 2 is historical cost. So if the land was bought for rupees 5 lakh 20 years ago, so even if its market value is rupees 1 crore, the balance sheet still may show it at rupees 5 lakh. Third limitation is it is based on judgment. Okay, so like depreciation provisions, estimates, they all involve judgment. So accounting basically involves professional judgment. Hello, now we'll understand the some of the basic accounting terms. This is basically the foundation section. So if you want to master accounting, then you must master its terminology. So let's understand the most basic terms. First of all, we have the entity. So business basically, business it is separate, it's separate from its owner. So if the owner withdraws money for personal use, so it is called as drawings, and it is not a business expense. So first is that business as well as business and owner, they are treated as separately. Then we have transaction. So transaction is basically any event that has a financial impact. For example, buying goods, selling goods, paying salary. So if it cannot be measured in money, it is not recorded. Then we have assets. So assets basically are the resources which is owned by businesses. For example, you may have cash, you may have machinery, furniture, building. So assets basically helps us to generate future income. Next we have liabilities. Okay, so liabilities are basically obligations. Okay, it can be loan, it can be payable to creditors, your outstanding expenses. So these must be basically paid in future. Then we have capital. So capital is the owner's investment in business. If the owner invests rupees 5 lakh, then that becomes the business capital. Then we have the revenue. Revenue is basically the income from normal business operations, for example, sales in a trading business. What is sales? Sales, the total revenue from the goods and services which is sold or provided to consumers. It can be the cash or it can be credit sales. Then we have expenses. Expenses are basically the cost we are incurring to earn revenue. For example, salary, rent, wages, interest cost, light and water, telephone, etc. Then we have profit and loss. Profit and loss. Profit occurs when revenue basically exceeds the expenses, and loss occurs when expenses exceed the revenue. So profit basically it increases the capital, loss it reduces the capital. Now let us connect everything. Now owners they invest capital, business buys asset, assets generate revenue, revenue minus expenses equal to profit, profit increases capital. So this is basically an accounting cycle. Hello. Next we have discount. So discount is basically a deduction in the price of goods sold. It means you are reducing the price. So if the listed price of the goods is rupees 10,000 and the seller reduces rupees 1,000, then your discount is rupees 1,000. So it simply means that the pays customer pays less than the original price. And we know it is offered in two ways. Okay, so there are two types of discounts. First of all, we have trade discount, another one we have cash discount. So we must clearly understand the difference between two. First of all, trade discount. So offering okay, so trade discount. Such discounts are called trade discount. It is generally offered by manufacturers to wholesalers and by wholesalers to retailers. Okay, so trade discount is basically given immediately at the time of sale. For example, your list price is rupees 20,000 and your trade discount is rupees 10 is 10%. Then 10% of 20,000 equal to 2,000. So here the customer pays rupees 18,000. So this discount is basically it is not recorded separately in books. Only the final amount of rupees 18,000 is recorded. So trade discount is basically a marketing strategy. It is given in business to business transactions. For example, manufacturer may give it to wholesalers, the wholesaler may give it to the retailer. So it is done usually to encourage bulk purchase. Next thing we have is cash discount. So after selling the goods on credit, the debtors may be given certain deduction in amount due to in case if they pay the amount within the stipulated time frame. So cash with discount is basically is given only in credit sales. So first the goods are sold on credit, later the customer pays earlier than the due date. So the debtor may be given a certain deduction. Okay, this deduction is called as cash discount. So if the due date is like 30 days but the customer pays within 10 days, then the seller may give small discount. For example, the amount due is rupees 10,000, the cash discount is rupees 800, so the customer pays rupees 9,800. Now we The last line is cash discount. It acts as an incentive that encourages prompt payment by the debtors. What does it mean? So cash discount basically it helps in cash flow. It motivates the customers to pay early. So unlike trade discount, cash discount is recorded in books. Hello. Next we have voucher. So the documentary evidence in support of a transaction is known as voucher. So voucher basically it means proof. So every transaction must have an evidence. So without proof, accounting entry should not be passed. For example, when we buy goods, then we get an invoice. When we pay cash, we get receipt. When we sell goods, we issue bill. So these documents are basically vouchers. Now vouchers basically ensures reliability. Remember earlier we discussed reliability, so this is how it is achieved. Next we have goods. Goods basically refers to the products in which business unit is dealing. For example, in terms of which it is buying and selling or producing and selling, the items that are purchased for use in the business are not called goods. Okay, so goods basically it means the uh, items that the business buys as well as sells. So it depends upon the nature of business. For example, for a furniture dealer, the chairs as well as tables, it is goods for him. But office computer, it is not goods. Okay. And if the item is bought for use, then it will become an asset. It will not become goods. For example, stationery shop buying calculator for office use, it is asset, but buying pens for resale, that would be goods. So this distinction is basically very important for journaling. Hello. Then we have drawings. So drawings means the withdrawal of money or goods by the owner from the business for personal use is known as drawings. Drawings reduces the investment of the owners. So basically, if the owner takes money from business for personal expenses, it is called as drawings. For example, owner withdraws rupees 5,000 for personal shopping, then it would be called as drawings. So important to note here is drawings basically it reduces capital. Drawings are not an expense because business did not spend it to earn revenue. Hello. Next we have purchases. So purchases are total amount of goods which is procured by a business on credit and on cash for use or sale. In trading concern, purchases are made of merchandise for resale with or without processing. In a manufacturing concern, raw materials are purchased, processed further into finished goods, and then sold. Purchases may be cash purchase or credit purchase. So basically, purchase when we are saying we are buying the goods for resale. We are not buying any assets here. For example, when we are buying 100 shirts, that would be purchase, but if you are buying office table, that would be asset. Purchases may be cash purchase or credit purchase. Okay. So when we say cash purchase, it means the payment is made immediately. When we say credit purchase, the payment is made later. Next we have stock. Okay. So stock is basically a measure of something on hand goods, spares as well as items in business. It is called stock in hand. So stock basically means on hand goods means unsold goods. So it basically represents the goods lying in store. Okay. Which are lying unsold at the end of the accounting period is called as closing stock, ending inventory. Now, closing stock basically means the goods which remain unsold at year end. Now, goods are left worth rupees 40,000. So that would be closing stock. Now, opening stock, on the other hand, in a manufacturing company, closing stock comprises raw materials, semi-finished goods, and finished goods, whereas on the hand of closing date. Okay, similarly, opening stock, beginning entry is the amount of stock at the beginning of accounting period. So, opening stock is basically the amount of stock which you are having at the beginning of period. For example, opening stock in previous year is previous year's closing stock. So closing stock basically increases profit, and stock is an asset. Next we have debtors. Okay. So debtors are the persons or other entities who owe to an enterprise an amount for buying goods and services on credit. The total amount standing against each person's entities on the closing date is shown in the balance sheet as sundry debtors on the asset side. So debtors basically, they are the persons who owe money to an enterprise. For example, if we sell goods on credit, then the customers become the debtor. For example, goods sold was rupees 10,000 to Ravi on credit. So Ravi will become our debtor. So debtors are basically assets because money will be received. Then we have creditors. So creditors are basically persons or other entities who have to be paid by an enterprise an amount for providing the enterprise's goods and services on credit. The total amount standing to the favor of such person or entities on the closing date is shown in the balance sheet as sundry creditors on liability side. So creditors basically, if we they are the persons to whom the entity has to pay. So if we buy goods on credit, now the seller will become the creditor. For example, we bought goods rupees 20,000 from Mohan on credit. So Mohan will become a creditor. So creditors are basically the liabilities because business must pay. Hello. So students, today we complete one of the most important foundation chapters of accountancy, that is introduction to accounting. So in this chapter we did not just learn definitions, we built the base of the entire subject. So let us now quickly reflect on what we understood. First of all, we learned that accounting is not merely about writing numbers in books, it's a systematic process of identifying, measuring, recording, classifying, summarizing, and communicating of financial information. We saw how accounting evolved from simple record keeping to record keeping in ancient civilization to becoming a modern information system that supports decision making in business across the world. So we understood that accounting is called the language of business because through financial statements, a business communicates its performance and position to investors, banks, government, as well as society. We also studied the branches of accounting. Branches of accounting, we had financial accounting, we had cost accounting, as well as we had management accounting. And we also understood how each branch serves a specific purpose. Financial accounting, we know, shows the past performance. Cost accounting, it controls the cost and improves efficiency. Management accounting supports planning as well as decision making. So we learn the qualitative characteristics of accounting information, that was reliability, reliability, relevance, understandability, as well as comparability. And we also understood that information is useful only when it is accurate, when it is meaningful, clear, as well as consistent. We also discussed about the objectives of accounting. First of all, we discussed the maintenance of records of business transactions, how we calculate profit, showing financial information, providing useful information to users. We also understood the role of accounting in business as well as society along with its limitations. And most importantly, we built our foundation by clearly understanding the basic accounting terms such as entity, transaction, assets, liabilities, capital, revenue, expense, profit, loss, goods, purchases, sales, stock, debtor, creditors, drawings, vouchers, less discount. Now you must understand something very important. This chapter is the backbone of the entire subject. So if you understand all these concepts clearly, then the journal entries will be logical, ledger will be systematic, trial balance will be easy, and final accounts will be meaningful. But if this foundation is weak, then the entire structure will shake. So, accounting is not just about memorizing entries, it's about understanding the logic. It's about discipline, it's about clarity, it's about responsibility, it's about truth in financial reporting. So, as we move to the next chapter, remember accounting is not just a subject, it's a system that records the past, explains the present, and guides the decisions for the future. And once you understand this foundation, the rest of accountancy it becomes a logical story. So if you found this chapter 1 explanation helpful, don't forget to like this video, share it with your friends, and subscribe to Ria's classes for more detailed concept based accounting sessions. Strong foundation today means strong results tomorrow. See you again in the next chapter.